Hello everybody, and welcome to part 15 of our series, Understanding Binary Options. In this particular video, we're going to revisit the Martingale strategy, which we had discussed in our second video, and we had referred to it as a simple strategy. This particular video is not just a revisitation of that strategy, but more specifically, we're going to talk about how quickly our debt can grow if things aren't working out with this strategy, if we're not being successful with it. And I think this is important enough to merit its own video, which is why I made this into part 15. So let's begin as we normally do with a quick overview of binary option trading. Essentially, we pick a commodity or currency or stock or index, and each of these has a value right now. Binary option trading relies on our ability to predict what the value of that particular currency or stock or index is going to be sometime in the future. We call if we think the value is going to go up, and we put if we think the value is going to go down. And if we're right, we get a percentage of the amount we invested, but if we're wrong, we lose all of what we invested. So essentially, the Martingale strategy tries to view each trade as not being independent of the other. They're linked in a certain way. If we make a bad trade, we use the information we learned to make the next trade smarter. And we base this particular strategy on the philosophy that no currency or stock or index can rise or fall indefinitely. No matter which direction it's going in right now, eventually it should bounce in the opposite direction. So if we just pick a direction, it doesn't matter if it's put or call, and we stick with it, eventually we're going to end up being correct. And whenever we're correct, we try and offset the losses that we incurred when we were wrong. And to do this, we need to successively increase the amount we trade. So let's take a look at an example of the Martingale strategy. Let's say the rate of return is 80%, and let's just assume that we're going to keep calling. You can substitute this for put. It's not going to affect the example in any way. So let's say we had the euro to the US dollar. Right now it's at 1.4. We invested $5, and as it turns out, we were wrong. So we lost $5. Had we been right, we would have made 5 times 0.8, that's the rate of return. We would have made $4, but we didn't. We were wrong. We lost $5. So we went again, and this time we invested $10. If we were right, we would have made a profit of $8, which would have recovered our initial loss from the first trade. But if we're wrong, we lost the $10 that we put in plus the $5 we put in from the first trade, and our total loss is $15. And this particular trend goes on. And you can pause the video and take a look at it all the way to trade 5, though we're going to go into this deeper in just a little bit, so we needn't stop here. Essentially, the question we're left with is how much should we invest in each subsequent trade in order to offset the losses that we've made on our previous trades. Now, this depends on the rate of return. The amount that we invest times the rate of return must be greater than or equal to the total loss that we've incurred thus far. In our previous video, video 2, there was a small typing mistake here where I'd actually put the rate of return on the wrong side of the equation. I fixed this, but it's more easier for us to view this in the following way. Essentially, the amount we need to invest must be greater than or equal to the total loss that we've incurred thus far divided by the rate of return. And all I did is take the rate of return on the left side of the equation on the above side and bring it down on the right side of the equation. And that tells us exactly how much we need to invest for any given trade if we're trying to recover a certain cumulative loss. So what do we need to be careful about when applying this strategy? This is basically a game about outlasting, and we need to have a lot of patience when applying this strategy. We need to have enough cash in order to keep upping the amount we invest until we get it right, and then we can offset the losses. And I want to stress on this need to have enough cash, because we're going to get back to this in just a little bit. And of course, there are no real guarantees. Things can still go wrong. Timing is very important. What if it turns out that we were right, the trend was going down and we were waiting for it to go back up, and it did go back up, but then it went down again? There are no guarantees. And when we place our trades, subconsciously I just went ahead and said bet, so there's a hint at what I think of binary option trading. But anyway, whenever we place our trades, the timing is really important. So now we segue from the Martingale strategy into specifically the context of this video. What happens when things go wrong with the Martingale strategy? How fast can our debt grow? So for the sake of example, let's say we make 3 bad trades using the Martingale strategy, and then we are trying to recover our investment in the 4th trade. So let's say we lost 3A. Why did we lose 3A? Because each time we invested A, right? Not quite. Remember, we haven't been trading with A each time. As per the Martingale strategy, each time when we're trying to recover previous losses, we have to up the amount that we're investing. Therefore, on the 4th trade, we're not trying to recover 3A. It's not A, the first trade, plus A, the second trade, plus A, the third trade. It's more than that. We're trying to recover, if we're trying to recover all of the previous losses, each particular trade, the amount we're investing, A, is not fixed on each trade. It's changing. And what should A be? If we're just trying to recover our losses, we're not trying to make a profit, we're just trying to recover the losses, it should be the cumulative loss incurred thus far divided by the rate of return. So let's take a look at a little bit of algebra right here. Let's say on the first trade we invested A, and we were wrong. It doesn't matter whether we put or call, we were wrong. And so our total loss after the first trade, indicated on the right side, is A. Now, the second trade, we can't just invest A again, because remember, if we do profit, we're going to make a fraction of A as profit, but in the first trade, we already lost A. So even if we profited from the second trade, it wouldn't be enough to offset the loss from the first trade. Therefore, the amount we need to invest in the second trade in order to recover the loss is A divided by R. But what if we were wrong this time too? In this case, our total loss is A plus A divided by R, and that's just the loss from the first trade plus the loss from the second trade. Okay, so what happens in the third trade? This time we need to invest an amount that's the total loss thus far, A plus A divided by R, which is A divided by R plus A divided by R squared. And if we're wrong again, the total loss goes even higher, and in the fourth trade, we're going to have to invest an amount that's even higher than what we've invested in the third trade, and so on. And we don't need to delve too deep into the algebra, and we're not going to try and establish a function for what this should be right now, because that's not relevant right now. Suffice it to say that each time we're wrong, our debt is increasing, and it's not increasing linearly, and you'll see that in just a minute. So let's try and move away from this algebra and let's look at some numbers, because I think that's the best way to understand the significance of this. So let's assume a rate of return of 87%. Why? Because I've looked across sites, and this is typically the highest I see sites offer. So let's assume a rate of return of 87%, which is to say that R is 0.87. And let's say we make an initial investment of $100. Why $100? It doesn't really matter. This is just for the sake of example. I think it's a reasonable amount to invest where one is trying to make substantial profits, but it's not too risky at the same time. Now remember, in order to break even after losing some money, the amount we invest in the I plus 1th trade must be equal to the total loss incurred after I trades divided by the rate of return. What this is trying to say is that in each subsequent trade, we're trying to invest an amount that's the sum total of the total loss from our previous trade divided by the rate of return. And we just saw this. So let's bring in some numbers. Let's say in the first trade we put in $100. We were wrong. Our total loss is $100. The second trade, we can't invest $100 again. We actually need to invest almost $115. And let's say we were wrong again. This time our total is close to $215. It's $115 from this trade plus the $100 we lost in the last trade. So in the third trade, we have to invest $247. And where did that number come from? Remember, it's 214.94 divided by 0.87, which is the rate. After the third trade, our total loss is 462. So the fourth trade, we have to invest 531, and so on and so forth. Notice that from the fifth trade itself, we're already into the thousands. That's how much we need to invest per trade just to break even. And if you look to the very bottom, by the 10th trade, we have to invest about $52,000 just to break even. Now, a lot of thoughts come to mind. Firstly, it seems to be that, hey, why do you have to assume that we're going to keep losing? And that's true. This is a kind of a worst case scenario. But that's also not the part that I really want to focus on. Let's focus on something like the fourth or the fifth trade, because these are the real danger zones. I think $100, or at least for me, $100, $200, if I lose that, I mean, I wouldn't like it, but that's acceptable in the worst case scenario. I can walk away from that. But once you start hitting the fourth trade and you find out that you're losing, our total loss after the fourth trade is about $993. That's where the danger zone starts. We start entering the danger zone, because here we're at a tough choice. What do? In the fifth trade, we know just to break even, we need to invest over $1,000. It's actually almost $1,150 just to break even. That's a lot of risk, because if we're wrong, now we've lost more than $2,000. But at the same time, if we decide, you know what, I don't want to do this any further, I'm just going to walk away on the fifth trade, I'm not going to go for it, then we know that we've already lost $993. And so there's a big risk that we're going to be like, oh, I can't lose $993. I'm just going to keep going because I have to recover this money. I'm in too deep. There's no turning back now. And that's precisely how people get stuck in this strategy. That is, at least when I've practiced a few times myself, that's exactly what happens. Even though I try to be completely rational about it, it's just a lot of money to walk away from. And so you continue, and if things don't go the right way, you end up losing even more. So the debt that we incur if things go wrong for us grows very quickly. It's easier to visualize. So just looking at this particular example, you can notice how quickly the amount that we need to invest just to break even, that's represented on the y-axis. You can see how quickly that amount increases as each successive trade. And by the 10th trade, we're already past 50,000. Whereas on the first trade, we started investing just $100, and that's so small it doesn't even show up on the scale. That's how quickly the scale grew. And you'll notice that these points, they don't line up in any linear fashion. There's no line there. That's what I meant when I said that the growth of debt per trade is not linear. It grows much more rapidly than a linear scale. And so if one gets, for any number of reasons, if one gets greedy, if one panics and one thinks, oh my God, I've already put so much money into this, I'm just going to keep going because I have no choice. I have to recover this. That's very dangerous. Now, honestly, there's no clear-cut answer here. Going back to the previous slide, on the fifth trade, that's a very tough choice. I don't know what the right answer here is. Should one invest more in order to recover $993? Or should one just decide, you know what, I'm going to tone it down. I'm just going to invest another $100. You could, and you could get that one right, but you're only going to recover a fraction of what you've already lost. On the other hand, if you just say, I'm going to call it quits, I'm just going to give up right now, you've lost all of what you put in, which is the point of this video, that all that you put in grows very rapidly as per the Martingale strategy. And I thought this was important enough to discuss, which is why, and I didn't really cover this in the second video, so I wanted to do a video about this. So again, I'm just going to highlight the slide that we talked about earlier, things to be careful about. This is very, very important to note. And please bear in mind the additional thing of what happens when things go wrong, because as you see over here, the debt that we incur can rise very, very quickly. So that's going to conclude it for this video. In future videos, we can talk a little bit about actually establishing a function to represent what the debt is going to look like, how it grows over time. But that's not specifically the intention of this video. The intention of this video was just to establish that it grows rapidly and it grows not in a linear scale. And so the Martingale strategy can be very dangerous if things go wrong. Please, please, please bear that in mind. And good luck trading. Thank you.